This is the Financial Coconut Podcast, Singapore's first personal finance podcast network. My name is Rakesh, and together with Anthony, we discover worthy financial news and derive insights for all you coconuts. We are part time investors with an intense full time career. If we can do it, you can too. So join us every Thursday for TFC Weekly Market Updates. Hey coconuts, welcome back to Weekly Thursday Market Updates, where we scour the net to find worthy financial news for you. This week, we have a new guest, Kelvin Wong, a senior market analyst at Awanda, and we're going to be touching on three topics as usual. First, Fed and ECB monetary policies together with China PMI data. How are these things linked? Why does it matter to us investors? We dive down deep with Kelvin on this one. We then talk about two lovely stocks. One is Apple. Second story, Datadog, a scale-up with a price-to-sales ratio of 14x. Is that still a good metric? More in this episode. Hey coconuts, welcome back to Weekly Market Updates with me, Rakesh.
And Anthony, we have another guest today, Rakesh.
Yes, it's back to our new format. And we do have a macro strategist here tonight. Kelvin, how are you?
Great. Thanks for having me on the show, Rakesh and Anthony. So, in fact, this is my first time to be in your podcast. Yeah, so pretty much happy about that and looking forward to our conversation later on.
Absolutely. I think Coconut's a quick thing about Kelvin. He's a senior market analyst at Awanda with over 15 years of experience in trading and providing market research on foreign exchange, stock markets, and commodities. Awesome. And for today, Coconuts, we have three stories for you. Of course, we've got Chief Kelvin in the house. So we're definitely going to be touching on Fed and ECB monetary policies. Our second story, we're going to touch on Datadog and its earnings. And of course, last but not least, everyone has to talk about it. It's Apple. To our first story. Kelvin, take us through what's happening with ECB right now.
Okay, so before about this ECB, right, because usually the most important thing is the press conference where Lagarde herself will go to actually give a forward guidance of what ECB policy would be. Of course, we know for sure that the last couple of months, ECB has been remaining steadfast of either 50 basis point or 25 basis point. So right now, we are looking at 25 basis point. So they kind of make a very pretty much clear stance that they are looking at inflation targeting rather than concerning about growth. Because now at this point in time, right, okay, before I talk about the Fed, right, so we have this expectation in the marketplace that there will always be a pivot by the central bankers. So as a pivot is a total change of its prior direction. That means, as you all know that for now, all central banks are actually hiking. So right now, there is actually bets being placed on the market saying that, hey, because you guys are actually tightening too fast, it will actually impact growth of the market. So they're expecting them to be a bit more like a proactive people. Proactive. That means before economic growth goes into a recession, they will actually prevent a recession from happening. So that's why we start to see certain stocks in the market, right, keep on rallying or outperforming against the rest of the pack. So one of them will definitely be the Apple, yeah, one of the Apple, the Nvidia, all those guys, yeah. But unfortunately, based on what Lagarde's ECB press conference, it doesn't seem to be they're actually leaning towards what market wants them to be. So they're pretty much concerned about inflation.
Okay, so I think immediate questions, right? One is there seems to be a bit of a divergence between Fed, where I think Powell's presser last week was kind of like, oh yeah, we're hinting. I mean, he keeps saying data dependent, right? But I think he changed some language. So instead of expecting a 25 basis point hike the next time round, he seems to be hinting more at a pause, right? And you have the ECB coming out and saying, hey, actually, I don't really care. I'm still really focused on inflation, so I'm going to keep hiking. And that is their hint to the market. And I guess the question then is, does this divergence, affect, let's say, US equities, for instance? Right? I mean, I guess European equities maybe because they go into recession faster, but it's not really our focus. In a sense, I buy Shell, but that's it. Right? And Shell is not really like a European stock. Does this divergence matter, let's say, if you're focused more on like the Asian equities market or the US equity market?
I think just to add some context there, our listeners, right, they're investing into stocks in the US, to Asia, right? Of course, some of them in Europe. So how does this impact?
Okay, so this is where the interest and the excitement of macro factors comes into play. Okay, because give you a context, right? We're talking about last couple of maybe 10 or 12 years ago, among my peers, right, they say macro is dead. Yeah, it's really dead. Why? Because the central bank
up to 2 years ago, macro was dead.
Yeah, so there was, ever since the great financial crisis, GFC 2008, 2009, nobody really focused on macro in their investment strategy or in their analysis. Why? Because the central banks are always keeping rates at near zero. So they actually smoothen the volatility of the macro factor. Okay, but so right now, right, with central banks normalizing, we call it monetary policy, with the exception of Japan, we got to look at international investors' point of view. That means, i.e., right, let's say, for example, if I am a player or a fund manager or the investment house, let's say be a pension fund, one of the returns that we'll be getting is definitely a raw return from the equity itself. That means you XYZ, you get dividend and the capital gain, right? But do not forget over here is that being an international investor, right, I got to factor in foreign exchange movement, which is pretty significant as well. Even you do hedging or all this, there will be a cost, all right? So some of them will actually do a partial hedge to actually take advantage of a potential movement in FX. So this is where central bank policy comes into play. One of the factors that could affect foreign exchange, because think of it, foreign exchange is always relative. It's not like you're just having a stock, you see. So if you are buying dollar or selling dollar, it's always against something. It's like you're buying dollar against what? So yes, I am purchasing dollar, but you need to sell something, right? So let's say, for example, if you are an international investor, you want to purchase USD. Let's say I'm a Singaporean. That means you are buying US dollar in exchange for Apple, but you need to sell away your Sing dollar. All right. So one of the returns that you could get over here is that the US dollar appreciate faster than the Sing dollar during your tenure of your investment. That means you make a gain when you actually receive dividend or when you exit your position in your so-called long US dollar shareholding. So interest rate differential is one of the factors that impact foreign exchange rate.
I guess then this is like the inverse of the US wrecking ball, right? So, where previously last year or this year, they were hiking so much that it kind of messed with the developing economies and their balance of payments and the exchange rates there.
Precisely.
Now because the Fed is pausing, but the EU and I guess a few other developed jurisdictions are still hiking, then that reverses the USD strength against these currencies. Not necessarily against the whole world of currencies, but against these basket of currencies.
Yeah, and you're saying that the US will be impacted because of what you said right at the start, being that you need to sell something in order to get euro, for example, and you're expecting that the US is going to be the ones that's going to have to supply?
Okay, so this question boils down to the demand of which country has a higher demand, or we call it the propensity of demand that could attract international capital flows into their equity market. So the European story right now is actually driven by, number one, is the growth of the China economy. Okay, because China is reopening and we start to see tourism.
And they all go and buy LV bags as well. LVMH
Correct.
earnings go bonkers.
So you see the particular stock, right, go all-time high, you see. So that actually create what we call a sentiment flow or feedback loop in our terms back into the European market. So what we could see over here is that if you look at certain European benchmarks stock index, like the German DAX is one of them, which is I think very close to about 3 to 4% away from its all-time high. So that actually explains this demand flow into this European country. The funny thing over here is that the story over here is that we're talking about a weaker dollar, which is being driven by that interest rate differential narrowing between US and the rest of the world. It's actually benefiting traditional emerging markets and countries that have huge US debt borrowing in terms of their corporation. Yeah, so EM is one of them definitely because they do not have the...
Because nobody wants their local currency. Everybody wants to denominate in USD.
Yeah, so they can't
issue... right? Nobody wants their local currency.
Yeah, so you can't issue emerging currency bond in the market to get fully 100% subscribed by the local currency. So they tend to actually issue in international currency. So USD is the favorite choice. And now the tricky portion over here is the China play coming into equation. Let's talk about the China PMI data. So I want to share about this PMI data. Yeah. So this China story, right? Because if you look at China, right, it's a very interesting market as per se. So a bit of context over here is China, number 2 economy, but their stock market in terms of liquidity and debt still lose out to Europe, still lose out to Japan, and still out to US. Right? So, but people still look for growth in their country. Talk about growth because of the way the government policy pushed it. But what happened last year or 2 years ago is that this clamped down, and there's this call it the COVID-0 very stringent policy that scare away investors, international investors. So we start to see 2 years ago the China stock market tumbled pretty badly into bear market territory. So even some of the China big tech stocks went from a high of 2021.
That's terrible. I think it went down 60% or 70%. Not as much as, let's say, not even Datadog, right? Not as much as some of the crappier US tech names, but yes, still a lot.
So the thing about China is that we got to take into account of what the top China policymakers in their minds. What are they planning to do? Okay, rather than by just looking purely at the macro factor and the business model of this individual major Chinese corporation. So late last year, there is a reversal of such draconian policy. So we start to see a lot of research houses saying that, hey, perhaps China is the place to look at again. Number one, why? Because valuation is cheaper, definitely, compared to the rest of the world, especially compared to US. So you look at the P ratio of China big tech like Alibaba, JD.com, compared to Apple, compared to Microsoft, is
A lot lower.
cheaper in a sense, much lower in terms of valuation. You look at valuation. Then secondly, over here is that we got to look into account of the China policymaker. So very clearly, right, there are some signs that, hey, the China policymaker say that the corona measures seem it's more or less over for now. We are now encouraging growth of such tech company. But tech company as per se, it seems to me that they are looking at some companies that are rather not internet platform company, but more of a hard tech company.
Hard tech, right? They want chips, they want semiconductors,
Correct.
they want
AI.
They don't want to sell more things and have more live blogging platforms.
Correct. So they are looking for this another kind of technology, you see, the tech thing. But on the other hand, they also require this payment company, which already have their so-called DNA inside their business model to help them push with their digital yuan. It's part payment, yeah. Okay, so now back to the interesting story is that the Chinese policymakers, right, in their key meetings, because the thing about Chinese policy, right, okay, because in US, in Europe, right, it's much easier, right? You have ECB, you have the Fed, so be it. But in China, there is a lot of community meetings and it's being chaired by a top person. He chaired a lot of this meeting who actually is a top-down approach. Okay, so one of the top meeting, the most one is a commonly monthly political bureau meeting. So in the last meeting, right, before the May Day Golden Week holiday in China, this particular political bureau meeting made a very bold statement saying that they are still very concerned about internal growth in China, which is weak. Okay, that means, i.e., they are very focusing on domestic consumption. They actually make a statement saying that expansionary fiscal policy should come hand in hand with monetary policy. Current PBOC governor still remains the same because initially we thought that he might be replaced by someone who is much more attuned with the current top policymakers' leadership role of thinking. Very interesting, he still keep this guy as status quo. So since October, right, when China starts to kind of reintroduce more stimulative or more accommodative policy from the fiscal and monetary side, PBOC has been taking a very targeted approach. That means, i.e., the loosening of this liquidity tap is a very slow and gradual basis rather than opening the tap at one shot.
Yeah, but so too much of an influx.
Yeah, so they don't want to have a boom bust scenario that happened in the past anymore. Yeah.
So I guess that's not great for equities. I mean, there was this, initial influx of, I guess, flows and liquidity from the international investors last October, which was great. But then I think people are realizing that, hey, the PBOC is not the Fed or it's not the ECB, and the Chinese government is not US government and helicopter money, right? Because it's not only monetary policy, it's also fiscal. The fiscal policy of China is also a lot more restrained in terms of, pushing money into the economy than what the US did, for example, in COVID. So, as an international investor, maybe you shouldn't expect the Chinese equity markets to behave like the US markets where everything went crazy in 2021 for the first 10 months, right? And instead, it's a lot more slow and steady. And because of that, your expectations and all that have to be calibrated a bit as well.
Yeah, precisely. So the funny thing about Chinese over here is that, the Chinese stock market is still run by animal spirits, based totally on sentiment, especially on the short term to medium term. So based on what Guardians from Political Bureau say that they are very concerned about weak domestic demand, which actually reflected in the manufacturing data as well, the PMI, as well as the services PMI. So growth did actually slow down. Definitely the manufacturing PMI went into a contraction territory for the latest month of April. That means they went below 50. New export orders went out as well. So that actually implied that international growth is actually slowing down as well, which is actually not good for Chinese manufacturers. Yeah. So now the funny thing over here is that because the dollar strength is weakening as well, because of Chinese top policymakers are concerned about growth. That means, i.e., they will do some kind of stimulative measure. So because of this, right, that actually led to a rally in the Chinese stock market. In the first, in fact, last week, the HSCI went up quite a fair bit, that outperformed the US market.
Where if we are looking at the Chinese markets, you're absolutely right. It's animal spirits in the retail side. That's why people go crazy over certain valuations, like higher, which is completely insane for a white goods company. But then at the end of the day, if we are concerned about structure, if we are concerned about flows, then that it's not the US market, and we all have to be very aware of that.
Yes, precisely. Yeah.
Got you. So I mean, as a quick summary to this story as well, right? We started off with EU raising rates, moving a little divergent from the US. what we're trying to say from there is of euro back into EU, which means more of a supply in the US, which could mean a devaluation of the US dollar. And then to throw into that with the Chinese and what we just spoken about, where they want a both seemingly not so steep growth curve, but at the same time use monetary and fiscal at the same time to be able to open and close the taps. And what that will do in impact to the Western markets is that based on the US weakening or anything that goes in the Western market, they will open and close the taps accordingly so that they will maintain a steady growth.
So right now we start to see the picture about China coming to place that yes, in short, China, the markets is still, the equity market is still run by this animal spirits. So for a longer term player, we need to really understand the tea leaves, read the tea leaves of the China top policymakers, which particular sector they are paying more into focus. Overall, in general, a weakening US dollar potentially could benefit the rest of the world, that means including China as well as Europe equity markets, potentially, yeah.
Got it. Awesome. And I think this is a great segue into our second story, right? Because we talked a bit
Apple
about
is a
the
Chinese
US
company.
Yeah, let me finish the sentence, Anthony. Yes, absolutely, right? So I think we can definitely dive into Apple here with the US side of things, with the China side of things. What's happening with Apple, Anthony?
Besides, Apple is a Chinese company, which actually was a very interesting article in the FT this week by some investment guy at Elliott Management. They had earnings, right? So what happened? Earnings kind of above expectations, I think, which is always good. But I don't know, right? I'm permanent. I'm not bearish Apple, but I don't always see it as overvalued. So take it with a pinch of salt. But at the end of the day, to me, Apple is about the strength of the global consumer. Because they are a consumer company. Earnings is up. It's earning what was EPS was at 1.5, 152. So it's 4-5% higher than expected. Revenue was about 2-3% higher than expected. Gross margins were great, right? You expect gross margins to fall, but as people start heading into a recession, but it was better than analyst expectation as well. I think from how they have performed from the past quarter, they have done very well, right? Their iPhone revenue is up and all that, but what if you look at it in different sequences? Year on year, everything is up, everything is above expectations. But you look at on a different level, actually at certain levels, your revenue was down. So actually, year on year revenue was down by 2.5%. Macs and iPad sales were down by 30-something%. It's not great, and we kind of could see this by AMD poor results in computers, things like that. So there is a bit of a weakening in Apple, I would say. It's just that people were expecting it to weaken a lot more than it actually did, which kind of explains a bit of the price movement, right? And yeah, back to Apple is Chinese company. Not that we've done the boring numbers. I think where this is coming from is two bits, right? One is the growth of Apple really is in two segments now. One is services, which was up. I mean, for growth engine, it wasn't great. It was up 5% year on year.
But from a lower base,
20
though,
billion.
right?
I mean, it's 20 billion, so it's 22% of revenue, so it's not that lower base anymore. I think it was a low base when we talked about it last year. But, it was like App Store payments, iCloud, Apple TV, all that kind of services, advertising, right? And all these are important because they are much, much higher margin products for Apple than traditional hardware like phones. So services is one growth engine that they have. The second is geographies, right? Like Asia is really the key driver, not only in China, but increasingly in India, where they opened I think the first 2 stores and they met the Prime Minister. And Tim Cook went there, met the Prime Minister, stuff like that. So, these are the growth drivers for Apple at this stage. And if you look at manufacturing, where they do all their stuff, it's still China. Right?
Yeah.
They have talked about offshoring or nearshoring. It's going to Vietnam, it's going to India and all that. But India has started one factory. I don't think it's even built yet. And when it's built, all it does is it takes parts from China and put them into the final form. So all the parts are still from China, right? You are not moving your entire supply chain into India at this stage, and it will take a long, long time to go. And this is where kind of the geopolitics comes in and why it's scary for Apple, in my view, right?
Yeah, I think just before you talk about why Apple is actually a China company, let's go back to that numbers again, right? iPhone sales, I was reading some articles that iPhone 14 didn't do quite as well as they expected. But you mentioned it's still gone up.
It's still increased. I think partially because they have increased prices. So total sales has gone up, but number of units
gone
hasn't
down.
been great. Yeah.
Got
It's
it,
been
got
great, but it hasn't like really matched up to expectations.
Got you. And I think, with the peripheries, which is your Macs and iPads and all that, last year, if you remember, they came up with the really cool 16-inch Mac and all of that stuff. So
Yeah.
obviously that's going to have a lot of hype and stuff like that. It kind of explains it. But I think it's great to hear about the services side of things, that they're trying to diversify. So I guess that's where Apple is trying to go in terms of, let's not bank everything on the iPhones. I think it accounted for 50% of their revenue, I think 2 years ago. So now they're banking on diversifying into services. Would you say that's their plan?
And I mean, it's obviously their plan, and it's been their plan for a bit. And you can see why, right? Because they have captive. Essentially, whoever uses an Apple is a captive in their ecosystem. You have to use Apple for everything, and Apple takes a cut of a lot of things. You pay $10 to buy an app in the App Store. Apple takes 30%, right? And they just kind of won that lawsuit against Epic, where Epic tried to circumvent it by directing people to a third-party site and buying off the App Store. And Apple said, nope, this is against my terms of service. You either delete that or I'm going to kick you off the App Store. Right? So, it's kind of rude, to be honest, anti-competitive conduct.
But I mean,
but whatever,
it's
right?
TOS.
It wasn't illegal. It wasn't illegal. The court ruled in Apple's favor. So, they'll be able to continue extracting that rent. As and when. They'll be able to continue extracting that fee for maintaining the App Store and making it a safe and wholesome environment for everybody. That's why they're charging it.
You practice in front of the mirror to say that line, Anthony?
I practiced very hard before in the afternoon, okay?
Got it.
But, you kind of... And then they have also started doing, I think, a lot more ads. And there was the whole ATT push as well, I think, 18 months ago that kind of messed up Facebook/Meta, right? Where you stop people tracking, and the only people who could track users on the Apple iPhone was Apple, and they took all first-party data away from advertisers, and that bolstered their advertising service because, hey, who has the best, most targeted data for Apple users who are famously rich? Apple, right? And that boosted their advertising revenue as well. So, I think this has all been kind of a cycle. They built a platform, they locked people into that platform, they made it super easy to use, great user experience, and then now they are extracting their rent from the platform, which is fair, right? Everybody does it. It's good capitalistic behavior. If they weren't doing it, you would kind of ask them, what the hell are you doing? Why are you not making money, right?
Got it.
Yeah.
Now, obviously, they're looking to expand into India. We've seen that. But there's also been this geopolitical tension between China and the US, right? And I believe Apple was right in the middle of that last year. Where they had to bring some factories across from China into the US as well. Now, clearly, they're looking at India as a middle ground to perhaps open something up. Would you say that's, again, their diversification plan in terms of hardware and manufacturing, just in case the tensions boil over?
Yeah, I mean, I think it's definitely a diversification move, and now it's a race, right? It's whether Apple can move out of China fast enough. Then China decides that, you know what, I'm pissed off with US now. I'm going to shut down Apple factories. I'm going to shut down Foxconn factories, and nobody gets an iPhone. At the end of the day, that is kind of an existential risk to Apple, right? Because if you lose 90% of manufacturing and you're a hardware company and you can't sell, new iPhones for 2 years as you spin out new factories, what are they going to do?
Exactly.
Their iPhones kind of die after 2 or 3 years as planned obsolescence anyway. So, and their business model is they'll continue selling you new models, right? So that is the problem. And I think this is, maybe a bit underappreciated, where, there is a lot of concentration, not so much in the sales of Apple, but in where they make their products that they sell, right? And, China has started showing displeasure of US because of the chip sanctions, chip behaviors, whatever you want to call that, right? And everybody's talking about decoupling of supply chains between the US and China. I think it really is a race between when Apple actually manages to do it, which is a very difficult task, and when tensions really get so inflamed and Chinese just go whatever, right? You can make, or maybe they go, you can make iPhones in Apple, but you can only sell them to China,
right?
Exactly. Only the Chinese can use Apple products. And then it's like,
wouldn't go that far. Actually, I would go that far to say, you know what, they could just flip a switch tomorrow and we're all screwed. But Kelvin, I mean, to ask you as well, doing the macro stuff. I mean, I'm sure geopolitical tensions between the US and China. I'm pretty sure you study that, you do that a bit. Any thoughts on this front? Because it's a race that Apple
Yes.
has to do.
Okay, so if you look at the current situation in terms of geopolitical climate, right? Before that, we talk about in the early part of 2000, perhaps after the dot-com bubble, where China goes into the WTO. So at that point in time, everyone is talking about globalization. That means where potentially we start to see things in terms of prices of costs and services actually went down dramatically. Why? Because MNCs will actually focus on where is the best place to produce at a cost that is lower. All right. So that's one of the reasons that you see inflation hovering below 2% during that globalization decade. But what we see in the last couple of years, 5 years, especially more pronounced last year, geopolitical tension rose. Okay, so China and US has been started since the Trump administration, and right now you throw in Ukraine and Russia, which indirectly impact China got involved as well. Okay, so what we could see right now over here is that we start to see a dismantling of this global supply chain. That means instead of talking about globalization, MNCs now are caught in this, we call it fire between different sphere of influence of countries that want to actually dictate themselves. I mean, hey, we have this particular US sphere of influence. We have another China sphere of influence. So they tell the MNC where you want to be, okay, which sphere you want to play, okay. So instead, right now we're now starting to see the rise of deglobalization. So with that, right, that actually impacted MNC's cost of production, or no matter how you put it, even though the cost of delivering their final products. So
Has gone up.
yeah, so if you look at the last 2 years, 1 or 2 years, right, some of these companies are aiming to actually maintain their market share. They haven't passed on these goods to their end user. But right now, we start seeing more and more this company, right, they couldn't sustain this anymore. So they will actually start to actually up their selling price. So that's why we start to see inflation, right? If you look at certain component of the inflation, especially the sticky inflation in the US or even in Japan as per se, it actually didn't went down. It actually didn't went down so much. It still remains pretty much elevated in the last 1.5 years. So that's one of the concerns, you see. And on the other hand, that means we talk about Apple cost of production will eventually pick up, okay, if this thing continues, because they are being forced to actually, it's not say that, hey, in best business practice, I will locate my cost of production in cheaper basis. Now are being forced to move onshore due to certain acts that is being come up by congressmen, right?
Yeah.
Something we're going to be mindful of. And also, do not forget over here is that Apple itself is, okay, we talk about Apple, yeah, it's a global consumer stock, but Apple itself is very important stocks in international investor portfolio. Why? Because you look at Apple, it's
Because
the
they're the
biggest
largest in
weightage.
the Nasdaq.
Yeah, in the Nasdaq and S&P. Okay,
And
so
S&P, right?
yeah.
It's all these stupid market cap weighted indexes.
Precisely.
That's the problem.
So it will create a negative feedback loop impact pretty significantly because of this is biggest weightage, you see, in the two most followed and most owned we call it stock indices, which is the S&P and the Nasdaq 100.
That's why you never dare to short Apple, right? No matter how you really never short Apple, because people just blindly buy the index. They'll buy a lot of Apple already. You can't beat that flow, and there's a bit of, I guess, support for that price, right? Just based on volume, and like traditional people DCAing and then buying indexes every
We are talking
month.
about those passive flows,
Yeah. I think we have more on Apple, but we'll make that into TikTok shorts.
We'll do
So
that into
look
we'll
at
do that
our
into
TikTok,
native shorts.
TFC Market Updates.
Absolutely. Okay, last story, folks. Datadog. Yes, small tech.
Finally, you get to say something, right? Okay, Datadog. Tell us about it.
So Datadog is actually cloud monitoring as a service, is what they say. So effectively, you can, they link very well with AWS, and you can monitor essentials like effectively matrices, traces, logs made to your application. How's the infrastructure going? Is it going to collapse? You need to, integrate with third party. How is that flow? How is all of the data flows happening with your platform and others? So that's effectively what Datadog does. Okay,
So they should sell to DBS so their iBanking doesn't go down.
I'm sure someone has tried.
Moral of story.
Yes. So they reported a loss of 8 cents a share, but I mean, it's still a growing company, so it's, that's quite normal. But one thing I want to bring up here, first things first, numbers. They reported revenue of 481 million, beating estimates, right? Actually, this is 30% over last year. So they're actually expanding quite a bit into the system. But I think one of the key things I want to point out here is they peg themselves very much as a part of AWS. You get AWS, it's almost synonymous for you to, or they're trying to be synonymous for you to get Datadog to monitor.
Does it mean that they kind of partner up with AWS sales? So when you sell AWS, the AWS person actually goes, hey, you know what? There's this other company, that is our trusted third-party vendor. You can consider using them.
Well, I think AWS themselves can't do that because I'm sure they have many third-party vendors that do this.
They have similar
Yes.
Datadog, right?
Yeah, of course. But Datadog will be definitely saying, you buy AWS, you should buy us, right?
Okay. So they are more, I guess their usage is more aligned to how AWS can be used.
Correct. Yeah. So AWS will never say that they are our only trusted partner. Let's put it that way.
Yeah.
So yeah, exactly. So, and they peg themselves so much is on their website, on their first page, right? On AWS, how is it going? Blah, blah, blah. So that's pretty cool. However, one of the things that we spoke about last week, in the short, was that AWS's growth was slowing down from 33 to like 15% or so, which then comes to mind on my side. What does that mean for Datadog, right? Yes, they're still forecasting a growth of so and so, but your existing customers, how are they going to be? Are they still going to have a net retention value of 130, which is what they boast currently, by the way? How is that going to be? That's my first question. Number two is that I still feel that if you look at Datadog's price, right, and for coconuts out there that are looking to invest into smaller tech like Datadog, they did see a dip during this tech repricing, but it's still one of the highest stocks if you think about it. Their price to sales is still pulling out at 14x.
Terribly high.
That's very high. But more importantly, if you compare to the peer average, it's around 10x. And yes, they are forecasting 22% growth. They're forecasting 30% net margin, etc., etc. But I mean, 14x is quite a fair bit to be saying, yes, I want to buy into Datadog. So I mean, those are certain things that I have, right? Datadog is very committed. They would say they're going to be expanding like crazy. But Anthony, Kelvin, what are some of your thoughts?
I guess one question from me is, as far as I understand it, Datadog is kind of hyperscaler agnostic, right? In the sense that it can work with GCP and Azure. It's just that they have just done a lot more business with AWS, which maybe kind of makes sense because AWS up to half a year ago was like dominant in public cloud. If their product works with GCP and and Azure, and if their salespeople are halfway competent, which I would really hope they are, although if you look at Cloudflare, maybe not, then I don't think the AWS tie-up is that big of a problem, right? Because they can, I mean, the question is really around product market fit, right? It's really around whether people do actually find their products useful and whether their products can be used on, all the big major cloud providers. If the answer to both those questions are yes, then, I mean, there might be a bit of a transition period where growth slows down a bit as, their sales processes retool and all that, and they start hunting for new targets. But longer term or even medium term, this probably shouldn't be an issue, but this makes a lot of assumptions that their product is good and they can sell properly, which are very big assumptions to make, I think, in this market for this valuation.
I think I get what you mean. The other company that I know that is actually aligning themselves more with Azure is Dynatrace, which is effectively the same thing.
But Dynatrace is private, I think.
Yes. I'm just saying, I mean, this is the competitor.
I mean, I don't know. I have shares of Datadog. They are surprisingly up now after the recovery. So for earnings of hooray, I'm finally back in the green. But I don't know, right? Like the more I think about the observability market, which is kind of where they sit, their attempts to land and expand, like everybody's doing the same thing, exactly. They are observability, then they move into like data processing and all that. Snowflake is going the other direction, right? It's warehousing and of data, and then trying to move into observability. Cloudflare is going God knows what, and they want to do everything now. So to me, there can only be one or two winners, because. And as early as we are into the shift to cloud, we are not that early anymore, right? And all of these users, all of these other things might not actually be business critical for something like PNG. You take a step down, right? Something like LVMH. Do they really need Datadog? or Snowflake to optimize their processes? Maybe not, right? It's all your new age companies that will want to do all these, and I think that kind of limits the actual TAM that they might have, and kind of limits adoption. So I'm very, very wary about things like this. I mean, I love the story, right? I love that, it's great. We are going to change the world. We are going to make businesses so much more efficient. They're going to be so much more targeted. But at the end of the day, will everybody need to do that? I think history probably tells us no.
And I guess that's where I'm coming at, right? Like, they are the ones targeting the newer age companies, which are crippling, right? The tech industry isn't doing very well at this point in time. And if you look at...
So do you have budget for Datadog to begin with?
Yeah, exactly right. And if you look at Snowflake, they're doing the other direction. So you need the warehouse. Then you then you move into observability.
I have shares in both of them, so as long as one of them wins, I'm happy.
Right.
Talking about own book here. Please buy all these shares and pump the prices up. Thank you very much.
Just buy index. Don't worry.
No. We are having an investing course to teach you how to do things like this. So yes, you should buy individual shares.
But exactly, and that's the point I want to bring up. After all these discussions that you and I have been having, it's still 14 sales, priceless sales. Is that really something that we can justify? Kelvin, I know this is not a micro in terms of tech and stocks, but not exactly your space. But what are your thoughts on this conversation?
Yeah, sure. So definitely, if I look from the macro perspective, right, 14 is clearly very price rich or expensive relatively compared to its peers. And if you look at the current situation in Datadog right now, right? Okay, so the thing about individual equities, right? There are actually two components that's driving the prices. One is the firm-specific factors, which Anthony and Rakesh, you guys have been covered through very in-depth, which is very, very interesting, insightful. Let's say if I talk about competitive edge, whether tech companies wants to use Datadog services or not. All right, so that is the firm-specific base factor. So another factor is, we call it the macro factor, or if you're talking about corporate finance professor, we're talking about undiversified risk.
It's screaming back to me.
or they call it systematic risk premium.
Yes.
Okay, they call that way. Yeah. Okay, so this macro factor, right now is actually playing a significant importance to it. Why? If you look at the year-to-date performance of Datadog, it's actually up close to 10%. That actually surpassed the S&P return of 7%, 3 percentage point, which is quite huge. Okay, so what I could see Datadog right now, right, what market perceive it is as a growth company rather than a company that is diversified and stable. When we talk about Coke or talk about McDonald's or Starbucks, it's a growth company. So in terms of growth company, right, being an investor, we tend to look at a longer term time frame of future cash revenue or cash inflow, depending on how you look at, or profit growth for this company. So it's a long haul. So we're talking about maybe 10 years, 5 years, or even more than that, all right, down the road. So in between, you may not be able to have dividend because this company got to reinvest their whatever surplus cash into their infrastructure to gain more market share or to improve their services to attract their customer. All right. The story here right now is over here is that earlier on we talk about the Fed, right? There's actually expectation in the market saying that, hey, the Fed is going to pivot this year based on
and they are wrong. Tell me they're wrong, right?
If you look at the case right now over here, is that the markets are now, okay, because previously we had this saying, don't fight against the Fed.
Don't fight the Fed. Yeah, not everybody wants to fight the Fed. The Fed is telling you they're not going to cut. That people keep thinking that they'll cut.
So if you look at whatever you see, right, on what happened in post-Fed last week, right, markets are still pricing in potentially before 2023 end, 1 percentage point of cut. Whereas Powell didn't give any clear indication. He said, hey, we are still inflation fighting. I'm not concerned about the banking situation now in US. They believe that the banks are still healthy. Okay, so he gave a pretty clear message. So, but the market don't believe him.
I don't care. You were going to have to cut. The banking situation is terrible. All of you will have to come and save the day.
Yeah, so now the next question being investors of such long duration growth company, or we call it long duration risky assets. What if the Fed disappoints the market expectation?
Which it will.
Share price collapse, time to 占便宜.
So this is something being it's part of the risk management process, you see. So let's say, for example, then do not forget over here is that because investing in individual component stock is pretty much different from basket of shares or like an index or ETF. So these are something that we got to be aware of. We are facing two risks. First risk is the firm specific risk, and the other risk we call it the systematic risk. Okay, this is the macro factor. Yeah.
Got it. Awesome. But it's you mentioned, I mean, to summarize, it is pegging it as a growth stock. So which is the reason why we're seeing this form of price to sales, right? Because I mean 14 is above
That's really
most of the other scale ups that you're seeing as well.
Right.
So yet to see if Datadog is going to be impacted by this AWS, or will they be sort of agnostic to just one company and move across the other cloud systems as well?
Yeah, I think I kind of preferred the world where macro was dead and I could just look at the company. Now you have to tell, oh yeah,
Systematic
company,
risk,
but,
no such thing.
No such thing, right? The Fed will just keep printing. They'll helicopter money down, it'll be fine. Now it's like, okay, fine, it's a good company. But, are we in the correct part of the market cycle? Are markets generally being mispriced because they have mispriced Fed actions? It's another layer of complexity, right? That's always a bit difficult, which is why we have started doing a bit more macro and a bit more study into it, just because you need to understand it. It's no longer the case where you can just buy a good company and forget whatever the price and forget about it, I think.
Yeah, absolutely. And on that note, Anthony, it's not that easy to pick a stock now. So we want to teach you guys, right?
Yes. I mean, not if you can't do teach, I guess. But no. Semi-seriously, we are going to set up a TFC Academy. It'll be hosted by me, and exactly what Kelvin has said, right? Macro affects micro as well. So we'll build that into the process. You'll start looking at how to do a bit of growth investing, value investing, dividend investing, in case some people like cash flow and want to retire early, like me, very important. So it's meant to tie everything together. I mean, we keep talking about a lot of things, right? And we keep hitting on the same themes and again. How do you buy? When do you buy? How do you look at companies? How do you think about companies? How do you think about macro? It's all our learnings over, I think, 2-3 years that we've been doing this and consolidating that, taking the best of it, including previous geek outs we have done and all that, into a nice package that everybody can access to if they pay us by signing up for the course. So if you're interested, head over to thefinancialcoconut.com, put your email in, we'll contact you when we are ready to start. Right now, there's a lot of information out there still, right? So we are still curating, still cutting down to make sure that you actually get an effective learning experience.
Absolutely. And I think once again, just to end this off, Kelvin, thank you so much for taking the time. I hope you had a fun coffee chat with me, Anthony and I.
Definitely.
We should actually get a beer soon.
Sure. So hopefully we have a real catch up, rather than virtual.
Yeah. Okay, Coconuts, thank you again. And again, leave us some feedback on this new experience. I would say a new show. Love to find out if you want us to continue this, so on and so forth. Thanks, and we will see you all next week. Bye.
All right, see you.
Thanks for tuning in to this week's episode with me, Rakesh, and trust that you learned something today. If you enjoyed the session and want to be part of the banter, join our community Telegram group or follow us on social media. We also have a weekly newsletter to get a digest of the news we covered. To sign up, please click the description below. As always, we love your feedback, so share that with us at hello@thefinancialcoconut.com. Thanks, and stay safe.